Brett.
How are you doing?
I'm doing well, thank you. We were
And
just
you,
talking
you
about Myrtle Beach because I went there and don't
Oh,
I
nice.
wouldn't necessarily recommend it.
I've not
oh,
been to Myrtle Beach in a long time.
Well, you're not missing out.
Yeah,
it's
I
like
know. I heard
Texas. You're not missing out in Texas if you're not there either.
I'm not. Well, and Greg and I both live here in Southern California.
Oh.
not for long.
I don't want to hear that from you. I'm very upset about that.
You're just gonna have to drive to Phoenix to see him, Julie.
I know.
Yep. Or in the summertime, I'll be coming back this way. Believe me.
That's it, right?
Yeah. Can you guys hear me? Okay. By the way, I got my my podcast mic in now.
Yep, I can hear you.
It's not the quality that I would think
Really?
you're used to. I don't know. What do you guys think?
Okay. How about now?
It
Oh.
seems like it's like in the background, but I don't know.
I moved it closer just now. Is that better? Or
Yeah, it sounds a little tinny, like you are alone, which you probably are, but
I am alone.
Yeah.
I am alone.
Poor Greg.
I wonder if I'm getting from my mouthpiece here instead of from the mic.
oh, could be. Like you have to change the audio.
I don't know, but if I unplug it, then I can't hear anything anyone's
Oh,
saying.
okay.
It doesn't come over my
Okay.
over my.
Oh,
So I
okay.
have to listen through this.
All right. Well,
How
it's
about
just
now? Does this change at all?
no.
Okay, then okay. I just dropped.
I'm just
that
gonna
down by
mind my
waist.
own business. Okay, I'm just gonna mind my own business.
Well, it's at least I know it's coming from the microphone. Is
Oh,
this
that
better?
sounds good.
That's
Yeah.
better.
That was a lot closer, so I just need to get this thing closer to my my mouth.
That sounds better.
I just need to
No,
talk like this the whole time.
You should just have to lean forward all the time, Greg.
Yeah. As they say, lean in. Lean in.
Yeah. Is this thing on? Is this thing on?
Oh my God.
Julie,
yes.
the weather there, I'm sure, has been much nicer than it has been here the last few days.
It has been nice. But we do have air conditioning now. So I'm lucky I get to run air conditioning. You always have to have air conditioning, not so much over here. So
no,
we're kind of excited.
Not always, but this time of year, yeah. Until like 2 weeks ago, until a week and a half or so ago, it was still in the 70s for the high, maybe low 80s, totally manageable. And all of a sudden last week it started getting up to like 96, 98, 100 degrees.
Yeah.
So yeah.
I haven't been to the beach in 5 years and I went. Now get it. I'm a mile from the beach and we went. So
that's pretty bad. You live a mile from the beach and you haven't been in 5 years.
It's indicative of I come from Chicago. We're a little bit different drive.
Yeah. Well, that's why one reason I don't mind leaving California is because I never get to the beach anymore now anyway. So since we live in, I didn't think it was going to be this much of a hassle getting to the beach from Temecula.
Yeah,
but it is.
It is. Yep, that's true. And everybody goes to Oceanside, so.
Yeah, exactly.
All right. Well, thank you for pushing over those questions. That's great. Thank you. Appreciate that.
Absolutely.
Yep.
Yeah, let's just we want to try to keep it to an hour. So we'll be jumping in with some questions and stuff, but at the same time, we got to be cognizant to keep things moving.
Oh yeah. Hey, question is Roger Jacobson. Do you know him?
That name sounds familiar. I can't place him off the top of my head.
I think he's from Brad's group. And
Roger
he got
Jacobson.
Married on Friday and died on Monday.
You're kidding me.
No.
What happened?
Terrible. I want to say a massive heart attack. That's the only thing that makes sense to me.
Oh my God.
You know him, Brett?
His poor wife.
Poor wife.
I remember speaking to him at some of the events.
He's not in my list, but that doesn't mean that we haven't met. My gosh.
Yeah.
Oh, that's unfortunate.
I didn't know him
So
personally, but
yeah.
Yeah, that's sad.
Mm-hmm.
That's
Agree.
too bad. Well, let's turn the topic a little bit happier because people are starting to join now. Way to kill the mood there, Julie.
I thought I would make sure you knew it, so you didn't hear it from somebody else. Julie didn't tell me that.
No, I appreciate it. Yeah, I'm gonna have to look him up on Facebook after this and see if he's someone I recognize.
Yeah.
From Salt Lake.
Yep.
Salt Lake. Okay. Oh man, not
Mhm.
too far away. I wonder if Karen knows him.
Good question.
Karen who? Do I know Karen?
Kara Clapp?
Oh, okay.
Yeah, Kara Clapp. She's a partner of ours on the deal we have together in Fort Worth that James helped us out with a few years ago. And unfortunately, her husband passed about a year and a half ago. Also, they were both partners of ours. So.
Oh, see the one the tall guy?
Yeah.
Yeah.
Exactly.
7'2", wasn't it? He's kind of tall.
Was it 7'2"? I thought he was 6 something.
No,
like
he was
high 6s. Is it 7'2"? Is that
he was 7 something.
Yeah.
Yeah.
He's the tallest guy I ever met in person. I'll tell you that, except for maybe, well, I didn't meet him, but I saw him 20 years ago. I not ran into, but I saw Shaq in one of the casinos, the Bellagio in Vegas, back in his day.
And didn't he wear a kilt or something?
Yeah, to the Christmas parties at Summer Rock. Yeah.
Yeah. Okay.
Hey, Rob, how you doing? All right. People starting to join. We'll give it a couple minutes before we get started. Let a few more people join in. All right. Yeah, everyone, please turn on your cameras and feel free to jump in and say hello real quick, especially right now while we're waiting for people to join.
Hey, Greg, Rob here. I'm not sure. Can you hear me this time?
Sure can. How you doing, Rob? Good to see you here, man.
Yeah, great to meet the group here. My name is Rob Dolarosa. I live and work here in San Jose, California. Just looking forward to just learning a little bit more. I'm new to all of this, and just so bear with me with my knowledge of all of this. I'm looking forward to just being a sponge with the group here.
Great place to start.
Fantastic. So Rob's another former retired Marine.
Oh man.
Yeah.
I'm surrounded by
We're everywhere.
Don't hold it against me, please.
Rob, I told Brett one time that he tried to say that there was 2 Air Force people somewhere, so I was outnumbered. And I'm like, no, if there's one Marine around, you're always outnumbered.
Yeah.
We'll take 1 or 2 more minutes and then we'll get started there. All right. For all the new people who just joined the last minute or so, feel free to please turn on your cameras if you don't mind, and if you're able to, feel free to jump in real quick right now and say hi. Say where are you here from?
Come on, Andrea. We're the girl power. Come on.
Good morning, everybody. I say good morning because I am here in Kuwait.
Oh, wow. There we go.
Yeah, I'm Andrea Chica. I am a new real estate investor, recently completed the military multifamily cohort in February. So I'm just here, to learn about,
Nice.
commercial lending.
Fantastic. Welcome, Andrea.
Yes, welcome here. And I'm assuming you're from the active duty passive income side. Did you see our post on there?
Yes, I did. That's how I joined.
Awesome. Welcome. And Long's probably the same way, right?
Yes. Hello, everyone. My name is Long, and same thing. I came from a cohort back with ADPI, and since then we formed a team, and we're still working on our first deal and learning a lot from a lot of other teams and creating our networks. And this is I feel like this is a great way to also understand a piece of our capital stack today. So definitely eager to learn from everyone.
Well, you got the right team on board here, Long. Julie's one of the best, so I'm looking forward to even learning from her more than what she's already taught us.
I'm gonna break it down for you all, so it'll make it really easy.
Anyone else
Thank you
want to
so
hop on
much,
and say hi
Julie.
real quick? I see Dietrich there. Dietrich, it's been a long time. How are things out in Virginia,
Sir,
man?
I'm doing well, sir. Doing well. So I'm Dietrich. I think Greg and I, we met at one of the Sumrock events, if I'm not mistaken. Yeah,
Yes,
back
sir.
many moons ago. I am a veteran at military Army. I kind of caught the tail end of that military joke, so I kind of definitely appreciate that. I don't have any doors on my belt at the moment. I just sold all of my single family, and I got my ears back and ready to get started. So
Fantastic.
Awesome.
Fantastic.
Awesome.
Well, welcome and glad to have you here, Dietrich.
thank you. I appreciate it.
Hello, everybody.
Dietrich, where are you coming in from? Oh, I'm sorry, Amit. Go ahead.
Yeah, I thought I'll introduce myself too. My name is Amit. I'm based out of Seattle. Vibeke, who is on this course, she actually invited me to this webinar. I'm a multifamily investor and just looking to network and learn from you guys.
Nice. Thanks for joining us.
And I'm Vibeke. I partner with Amit, and I am driving right now, so you can hopefully hear me. I don't know if you can see me, but I'm excited to learn from everyone, and hope to be home very soon so I can start taking some notes.
We hear you just fine, and be careful driving. Don't get in any accidents or anything.
Not at all.
All
That's
right.
the plan.
All right. Well, everyone, we can officially get started here. Welcome to our roughly monthly, every 4 to 6 weeks, Patriot Investor Virtual Meetup. This is our third one, and this is the first one that we've had a guest speaker for. It's a good friend of mine who we actually used to have a physical meetup here in the San Diego area until about a year ago. Julie Peterson. So we'll do a quick intro here in just a minute. Who we are real quick. Brett and JJ and I, I'm sure anyone here knows one of us, or but possibly not, because I guess as people who saw this on through ADPI, and heck, we welcome anyone. So my name's Greg. I've been a multifamily investor since I started off as a passive investor in 2015, which is right when I retired from the Marine Corps. I was a combat engineer officer in the Marines for almost 20 years. I live just north of the San Diego area in Temecula, California, but not for a whole lot longer. I'm going to be moving to Arizona here later this year. And then my partners, JJ and Brett Hadley, we have a deal together in Fort Worth for the last 2+ years we've been working together, and so I'll let Brett give y'all's intro.
Thanks, Craig. Welcome, everyone. It's an absolute pleasure to be in the same room with two of the guys that are partnered up with me right now, and Greg and JJ. That's how fast we have grown, is having the ability to first having our military network, and then cross-pollinating. That's how Greg and I got in touch with each other. We joined the same mastermind group, the Sumrock group, and it's just incredible that I hear people all the way from Kuwait talking about dialing in and wanting to build relationships. You're doing the right thing. And 5 years ago, would not even imagine how fast we've grown, and to be in a position that we are in now to help our service members. And we're a part of the 10X Bets. We're a part of the ADPI community because of that. We love to give back, and I'm on my 19th year in the Air Force, and looking forward to jumping all in. And in 9 months, just gonna be full-time and doing real estate because we can. because you guys are doing the same thing right now, in advance, and you're making that move and you're taking action. You're jumping on calls at 7 at night or 6 at night or wherever the case may be, even in Kuwait in the morning. So I want to give everybody a round of applause for taking that step and getting out there and learning more. JJ, I'll turn it over to you.
Yeah. Thanks for joining, everyone. JJ Hadley here out of Rock Springs, Wyoming. I'm I like to call myself the asset manager of the deals that we do. I like to take the business plan and run it start to finish. Brett and I started buying smaller multifamily units in 2019, joining calls like this, learning about real estate. And now we've got about 750 units in our portfolio and about 45 million in assets under management. So it's a good place to start and can continue to learn. Thanks for joining.
And who do we have here today? We've already listened and heard from several folks, and so thank you all for coming on and talking. But we have the BluSky Investor Group Club members. That's the Greg Butchers you see in the background of Greg. We've got our investor group members, and then the guests. That's awesome. So anytime we get referrals and folks that want to bring other folks on board as well, we want to welcome them, because we're here to help anybody who supports our military and the Patriots out there. Next slide. Purpose. Why do we doing this? This is the reason we're doing it, because every one of the people on this call is either a Patriot or a veteran. And we are continuously trying to help our veterans understand that, hey, when you are out of the uniform, whether it be retirement, like Greg was mentioning, he retired in the Marines. We've got several folks on here either retired or getting ready to retire. We're wanting to build that, let's just say, that education and that ability to understand that there is a way that you can build and become financially free, and you don't have to go into a W-2 job. Like, you can do it, and it's all about taking action, doing exactly what you're doing tonight, surrounding yourself with people that are doing things that are much bigger than you are. And guess what? And we're here, and if you already are financially free, we're going to help you even gain even more advantage and build that legacy for your family in the future. Next.
Okay, absolutely. So as Brett mentioned, we're here to serve veterans and patriots. Do you have to be a veteran? No, absolutely not. But our whole purpose is, if you don't love the country we live in here, then you're probably not part of our tribe. And there's a reason for that. So we want to thank all of you who are our tribe for being here and invite you to continue coming to these in the future. For right now, I'm going to turn over the floor here to our good friend, Julie Peterson. Julie's a loan officer with Old Capital Lending. Julie, I think it's been, about 4 years or so, 5 years now? Is that probably about 5 years that
I've known
each other?
Mm-hmm.
Yeah, yes. Yeah, exactly. So Julie, she's a loan officer with Old Capital Lending, who we've used before, and they're fantastic lending agency. She's also a multifamily investor herself through her company, Dancing Investments. And I'll let her tell you all a little bit more about her. And I was going to originally play Dancing Queen as I introduced you, but I forgot, and I just don't want to have any more time, because anything dancing is all about Julie. So Julie, I'm going to stop my screen share here and let you take over with your slides right now. Okay. Too.
Sure. I actually thought we were just going to have a conversation. So
okay. Okay. We thought you were actually going to share those slides, and you don't have those up?
I can bring them up. I just thought we were going to have a conversation. That's okay. What I thought
no problem. Sorry for the confusion. Feel free to show them as just as talking points or whatever, and you don't have to go through everything. But yeah.
Okay. Well, let me bring them up then. Sorry about that.
No worries.
We were playing around earlier, so let me just make sure that you guys can see these. Let me share. Boy. Okay, hold on. Where are you? There we go. Share. And here we go. Share. So you should see my screen, but I want to make it.
There we go. It's good.
Can we do, did it go away?
It's in the slide. It's showing your slides, but it's in the slide view. It's not like presenting.
Here we go. Now we're good. How's that look?
Good.
Yeah, there we go. That's the one.
Perfect. You don't see two slides, correct?
Nope.
Okay, perfect.
This is perfect.
All right, good. We're professional now. All right, well, welcome everybody. Thanks so much for the opportunity, you guys. I've been tracking you, especially Greg. I've been tracking for quite some time. Met JJ a couple years ago at a conference, and it was a real delight to meet with you and see what you guys are doing. So today I'm here because I want to make sure that everybody understands, as a passive investor, I know that that's a lot of you are passively investing, but also potentially as a general partner, what does it look like from the lending standpoint? So we're going to talk about my company, Old Capital. I work for Old Capital, some financing options, and then opening it up to questions and answers. So again, I'm with Old Capital Lending. We've been in business for 38 years. I've been doing business for 33 years in residential, and then got into multifamily about 15 years ago. So we at Old Capital have closed over 8,000 loans, which is a lot. We close typically yearly, 1.2 billion. And if we look at the Texas market, we close 1 in every 3 loans, which is a lot. So a lot of people know Old Capital because we have great relationships with not only lenders, but also with broker firms. So we also do a lot of business with education programs. So we do loans on all aspects of commercial real estate, but we really are specialists in multifamily. Again, I've been doing this for 33 years, and for so long, I was owning and operating my own single family, then got into a 12 unit, then got into a 20. And my lenders were like, just get away. We're done with you. Because they always told me, you need to have partners. And I was like, I'm not having partners. I can do this myself. I called it like, what's her name? Edna Mode. People think I look like Edna Mode. And she says, no capes. You cannot wear capes. But I was trying to wear a cape for a long time. And so once I took off the cape and said, I need to have some partners, that's when everything worked for me, started to really take off. So I'm a little different from a lender standpoint because I am an owner and operator. I've been in the trenches. I've capital raised millions of dollars. So in a lot of positions, I say that there's 3 positions in typically all of these deals. You have a capital raiser, you have an acquisitions manager, somebody who goes out and finds them, and then an asset manager who manages them. I've done all 3, and not a lot of lenders can say that. So when we're in a deal, I'm helping negotiate. I'm helping look at things a little bit differently. But from an education program or position, Old Capital really, really takes a lot of time to educate our investors. And so we do our Old Capital Conference, and all of you are welcome to join us. Old Capital Conference is October 9th and 10th in Dallas. You'll find all the people you need, brokers. You'll find obviously us lenders, investors. You'll find insurance and attorneys. So great place to go. I've put the websites there. The Old Capital podcast has been over, I think, 8 or 9 years that we've been doing it consistently. Paul Peebles, who owns Old Capital, and Michael Becker, who used to be a lender, they sit down every week or every couple times a month and talk about what's happening in the industry, in multifamily, in lending. So great place to listen at what's happening in the market. And then lastly,
that's one of the best podcasts out there too, Julie. That's how I got started. Well, not all of how I got started, but when I was just getting started in the industry, that was a big source of information for me, is listening to the Old Capital podcast.
Yeah. I would agree with you, and I still learn from as an owner and operator and loan officer. So, and then last thing is Zoom at 8, and I do this every Tuesday night. You're all welcome, and this is a place where you will find partners, but also we have a live conversation with industry experts 3 weeks out of the month. So last night I had an education program came in, explained their program. So if you're looking for something a little bit more, Zoom at 8 might be a great place for you to develop your team or find investors. So that's a little bit about us. But I really was here to, I wanted to bring to you information because as a passive, because when you're looking at deals, you have to understand how these operators are looking at this deal. So not only are you trying to figure out who they are, but when they say, oh yeah, we've got the finance figured out, dig a little deeper. What do you need to know about lending? So first and foremost, you need to kind of figure out where you want to invest. And I always say invest in an area that's close by you. Well, I'm in California. I'm done with California. I don't recommend California because you're not going to have the cash flow that you'd get in some of the other areas. And in the bottom part of this map, you'll see, we call that the smile states. And these have been grossly impacted over the last 2 years because everybody said, I cannot get a deal, so I'm going to go build. And so we're seeing all of those people that got into multifamily 3 years ago, they're now delivering. And this is impacting a lot of these markets in those smile states. So I recommend, okay, maybe you don't do the smile states, maybe look at the Midwest. It might be a place immediately to take a look at. Now, the smile states are coming back, and Greg is going to a great place, although I'm going to miss him, to going to Phoenix. You know, Phoenix grew by leaps and bounds, and there's a lot of infrastructure in Phoenix, but they're overbuilt. And it's going to take some time for all of that absorption to take place. And so in the meantime, rents are going to be a little bit lower. It'll take time to get those rents up. So thinking about what market should I be looking for and who's investing in those markets. Okay. And you're hearing
just a couple of years ago, it was kind of the other way around, wasn't it,
Absolutely.
Julie? Just a couple of years ago, the Sunbelt states are where it was at. And it was those up the Midwest states and the East Coast that no one was really investing in as much, and you weren't getting as good returns there.
100% agree with you. So things are different.
Even this is kind of a season though, too, you know, so it's just because that's the way it is today. And this year, you know, doesn't mean that's the way it'll be 12 months from now necessarily. I think there'll be some tendencies, but there'll be movement, of course, too, back in the right direction, I think, you know, depending on the market.
I do agree with you. So it's understanding the market where we are today, where we're going, but nonetheless, the fundamentals are still here. We're seeing some rent growth, and I wasn't going to go too much into what's happening in the market, but if you've turned on your TV or if you've tried to buy a house, you know that the interest rates are up, and they went up considerably back in 2000. Well, we had the COVID, everything went to, you know, hell in a handbag, and then everybody jumped in using bridge lending and didn't recognize that, what's going to happen with these adjustable rate bridge loans. They went up and they went up and they went up, and they didn't stop going up until 9 or 10, 11 interest rate increases. And we've stayed there historically, not where we've seen the market and inflation. So the combination of interest rates, inflation, jobs, delivery, it's caused some sense of concern for investors. So we want to make sure that you understand, you know, there is a risk in all investments, whether it's the stock market or it's multifamily or it's, you know, senior housing, whatever. But if you say, what is a normal interest rate? We're not that far off. We really aren't. So really want to make sure that you get a sense of where are we going and how do we get these deals done? Now, as a lender, we call ourselves bankers because people come to us for money, whether it's going to be from a bank standpoint, bridge. There's a couple different kinds of bridge. We've got fixed and adjustable. We have agency, which we call the gold standard. That's your Fannie and Freddie. They also have Fannie and Freddie on the residential side, but this is different. This is going to be non-recourse, which we'll get into. We have CMBS, hard money, gap funding. If you just can't get over that last 500,000, we can help with that. Life insurance companies are also get into this. And then another government-backed entity is HUD housing, HUD financing, FHA is another. So we're going to spend time today talking about agency, bridge, and bank, because that's where you're going to see the majority of these deals getting financing. But before we do that, I think it's very important that everybody understands what is recourse lending versus non-recourse lending. And I would like to see a hands, and maybe you can find the little thumbs up if you are aware of what recourse versus non-recourse lending looks like.
Yeah, if you go to the reactions button on the Zoom browser at the bottom, there should be an option to put your thumbs up or raise a hand or something like that.
And Greg, I can't see that, so if you would just tell me what that looks like, and then I'll get to understand. So I'll go either real in depth or we'll just do a quick overview.
Well, if you can see the people, the thumbnails of people who are participating, sorry, I may mispronounce your name. Vibeke just had her thumb up just a second ago. It showed up on that thing. So let's see who else. Anyone else?
So everybody else. Okay. Dietrich,
Julie, I think we have a wide range of individuals. We've got, some folks have done several deals. We've got folks that are brand new. So if you just want to go in at a 30,000 foot level, that'd be awesome.
Perfect. So recourse, if you think about when you buy your home, they're going to look at your tax returns. They're going to find out what income you have. Have you been having a job for a while? Recourse is a personal guarantee. So if something were to happen where you were managing this property and everybody moves out, you have a master lease, everybody moves out, and you have no income coming in, you go to sell that asset and you sell it at a loss. You are personally responsible. Each person is 100% responsible for that default, for that difference. So I'm going to be responsible for the $3 million. Greg is going to be from 3 million, and so is JJ. Okay, we're partners. We are 100% liable for that. Honestly, deals you're always going to be liable for some way, somehow. So I don't want to say don't do recourse, because that's dumb. You want to have an option. So I like recourse. There are reasons why we will do recourse, and we'll talk about those in just a second. Versus non-recourse, which is, yes, you're signing on the loan. You're guaranteeing that your LLC is going to be making payments. But if there's a downfall and a shortfall, I should say, you are not personally liable for that shortfall. So why wouldn't you want to have non-recourse? It separates you from some losses. Here's the thing. If you have illegal behavior, let's say you have bankruptcy in the middle and you don't disclose that, that could be a possibility that would go from non-recourse to recourse. We call that bad boy carve-outs. So as long as you're behaving nicely and doing what you can, then it will stay non-recourse. We have seen people in this industry that have had bad behavior and it goes into recourse. So you want to be careful. Agency is a great way to get these deals done. And the majority of people in multifamily use this type of lending. But you want to make sure that you're doing exactly what they're asking, right? You want to take care of your deferred maintenance. You want to give them all of their reports. So it's a little bit more reporting, but we highly recommend this type of lending. Are there any questions
Julie,
on recourse?
For recourse versus non-recourse, how does it affect things for passive investors? Does it change their risk whatsoever?
No,
how does that affect them?
It does not affect their risk. If you think about, and we use this analogy quite a bit, as a flight, right? The general partners are the pilots in an airplane. Yeah. So they're flying it. The general partners are navigating. The limited partners, and they're taking on responsibility. The limited partners are all of the people in the back of the plane. They're, getting served. They're getting their reports. They're getting, updates, how the flight's going, but they do not take any responsibility for the loan or how this asset is performing, good or bad, right? So we're always hoping that it's going in the right direction. But if there was a default and you were in a recourse loan, you as the limited partner would not have any quote unquote recourse to that you would be responsible for.
Yeah, I was talking with Rob the other day here, who's on the call, about the difference. And this is something that comes up a lot when I talk to potential investors. They don't understand what the advantage might be for investing passively in a syndication versus just going out and buying a rental property on their own with it where that they own and they control by themselves. And there's pluses and minuses. One plus for that would be control, but a huge minus would be like what you just said. Now you're taking a recourse loan out on your own credit report and if something happens, well, they can go after everything you have up to the limit of that loan. So yeah. Whereas with as a passive investor, you're not on the hook for the loan, and you're not on the hook for anything past the amount of your investment.
Yeah, absolutely. And listen, when I finally said, hey, I want to go to the next level, my husband said, I am out. I'm done. And I said, well, I'm not done. I want to go and continue my this buying and owning. And I went in, I transferred all of my active into passive, into larger deals. And one of the things that I loved is that I didn't have to call my husband to fix up any of the maintenance, which was great for me. But what I really missed is that I was used to looking at my operating statement every day. What's happening? Where are the tenants? All of this. I was used to that. When I got into a passive opportunity, I didn't see that. I saw it on a quarterly basis. I even saw it on a yearly basis. And I knew that for me, that was not going to work. I needed to see it more often. And even as a passive investor on a monthly basis, sometimes that makes me crazy because I like to know what's going on. So that's some of the things that you want to be thinking about. If that's something that you want to know things more, get updated more often, then go with an investment group that has those updates, or ask, hey, if you're doing these quarterly, can I get a monthly update? So because that's what worked for me. Just something to be thinking about.
Absolutely. It's a great point.
And most likely, Julie, you probably wouldn't invest in an operating group if they wouldn't be willing to do that. So that's probably a question that you're doing in advance. You're talking with before you actually send over and wire your funds. You're saying, hey, this is what I'm going to require as an LP. Are you guys willing to do that? And if they're not, then you wouldn't invest with them, right?
Absolutely. Great point. And in our operating agreement or PPM, it will say that we are required to provide you with quarterly reports. So, we put that up front, but we have done monthly, especially in this time and in this environment. We want to make sure that everybody feels secure. And so you have that conversation beforehand. Great point. All right, let's carry on.
Real quick, Julie, there's a question in the chat box from William. He's asking whether recourse versus non-recourse affects the loan rates or fees.
It does. So recourse is going to be on your bank financing. And we're going to get all into this. When we look at, I showed you that map, and in the Midwest, you've got great rental growth in the Midwest. So the NOI, the net operating income, has increased in those markets. So a lot of lenders, whether it's agency or bank, so that's recourse or non-recourse, they're bullish in that market. They're going to give more deals to those markets, where maybe in some areas where they're not making as much, rent growth, we've got some occupancy challenges, they're going to be pulling back. So depending on the market, if it's a tertiary market, you may not get as much leverage from, let's say, the agency, and you might get better leverage from the bank, which is recourse. So it is a challenge, and that's what we do. We marry the right financing with the business plan and where it is. We're really specialists in that. Does that make sense? You good? Okay. So I want to bring to your attention agency. Again, this is your gold standard. And for those of you who are thinking about, hey, maybe I want to be a general partner, this would be good information for you to write down or take a picture. If you are a passive investor and that's all you want to do, this is an idea of what the general partners need to qualify. This is what they have to, the guidelines they need to be qualified for. Okay, so there's 4 requirements. 1, and again, this is Fannie or Freddie. We call it agency, and each one has little different nuances. I'll try and point those out, but for the most part, we're going to talk about agency as a whole. So 90% occupied for 90 days. So the assets that agency wants to have are quote unquote stabilized assets. And when we say stabilized, we're first looking at that as 90% occupied. Now, stabilized could also mean that we've got regular cash flow, we've got occupancy, but the rents are really low. That in some cases, that would be considered an unstabilized asset. And so it'll depend. Agency is really longer term debt, longer term amortization, so lower monthly payments than what you would find on a bank loan, let's say. So the first one, 90% occupied for 90 days. And it needs to remain at 90% occupied. Otherwise, it could get kicked out. Second is net worth greater than the loan amount, equal to or greater. So net worth, that is going to be your assets minus your liabilities. Each one of you has a net worth. Do you know what that is? Have you ever done a personal financial statement or a schedule of real estate? This is what we're going to look at as a lender, how much you're valued as. And then what I like to do is do that up front and to figure out, hey, what do you need for your team? You're worth $1 million and you're going towards a $10 million deal. You're going to need to find some partners. So it's great to know your net worth and then go out and try and find, oh, I'm looking for somebody who's worth 8 million because that's what the assets I'm looking at. So really good to know what your net worth is and then a roadmap for who you're looking for. Third is liquidity. And liquidity is cash in the bank or marketable securities. Now, marketable securities could be considered your insurance policy that your husband took out on you that's worth $10 million. I know you guys love each other, but there's something going on there. No, just kidding. There is a cash value to that marketable security. That's what you get to use. And if you have a $10 million policy, it's probably only worth 50 to 100,000, depending on how long you've owned it. But that's one way called this type of liquidity. The other one is going to be your stocks and bonds. So there's a cash value of your Google stock, your Apple, Oracle, all of those have a value. So we're going to want to know that. If you've got a lot of stocks, you are really well positioned to become part of a general partnership because a lot of operators, we like to put our money into deals. We don't like to have money sitting around. So if you have a large amount of liquidity, you can start to ask some of these groups, hey, I'd love to bring this liquidity. So think about that. One thing you got to know is cash in the bank is not part of your IRA, okay? Because you're going to find net worth and you're going to add that into your net worth, but it doesn't show up as liquidity. So anything that's wrapped in a 401k or an IRA cannot be used for your liquidity, okay? And then the last piece is experience. So again, we've got 3 people in the room that are operators. These are the people you want to use if you're looking to build your business in a partnership. Okay, Greg, JJ, and Brett, they all have done this before. Okay, so you're going to use their experience. What we're going to look at from multifamily side is 2 years of experience. Now, if you come from single family and you have 10 doors and you've owned them for 2 years, agency just opened that up and said, we will allow you in. They didn't do that for me 15 years ago. They said, go away. So this is a great thing. If you know some family members that have a large portfolio of single families, go knock on their door. See if they will be your sponsor. Could be a great way to start your business. Now, the one thing that nobody talks about is this equity. The people who are operating these deals, they need to have money in the deal as well. They don't just walk in and get it for free. They have to put their own money in. And the guideline says, of the equity brought in, I need you to have 5 to 10% of your own capital. So you can come in without any money, but you have to have the right partners that would support that, all of these requirements. So let's
the team as a whole has to have skin in the game, right?
Exactly. But maybe, Greg, you don't have skin in the game, but you're part of the team and your rest of your partners are going to. What does that look
Absolutely.
like when Greg is going out and saying, hey, can you bring money into my deal? And somebody says, and every one of you should ask this question, how much money are you putting into this deal? If Greg says nothing, that doesn't necessarily give you a good sense that he's in support of this. Greg and this team, they're going to put money in the deal. And so they want you to be alongside them, right? So I want to give you an example of how this works. Again, this is your top-notch type of lending. $10 million deal. Right now, we're transacting between 65 and 70. And so for this example, we're going to just say, I'm bringing 7 million. Your lender is your biggest partner. I'm bringing the most amount of money. We're going to build a great relationship. So what I need from you is a net worth of, remember, it's equal to or greater of net worth of the loan amount. So I need 7 million in net worth. I need 10% in liquidity. That's 700,000. I need you to have your experience. Now, we'd love it if it was in Fannie and Freddie, but by the way, we will take bank. We will take experience, again, on the single family. And then I'm going to look for I'm bringing 7, you're bringing 3 on your equity. I need 10% from your team. So you guys are going to need to bring 150 to 300,000 in capital to the transaction. So that's really important. I broke it down very carefully and succinct. So what,
Julie, I want to put a quick plug in if you don't mind, real fast.
Yeah.
About 7 million in net worth, and you mentioned net worth is one of the requirements in the last slide. So there's quite a few people here attending who are maybe they're still serving in the military or they're military veterans. Once they're out of the military, or possibly even while they're still in the reserves, they can get a VA disability rating. And if they have their VA disability rating is over 50%, then they are getting I'm getting too technical. So if they have a disability rating, they may be getting funds from the VA, non-taxable funds, but that's income for them. And for people who haven't thought about it, if you have your IRA and you're putting together a loan application, okay, or your 401k, what you put on the income portion on your income statement, because whether you're getting making any withdrawals from it or not. And you see a plan balance that you can put as an asset on the balance sheet. But for something like VA disability benefits or military retirement, we never see any plan balance. All we know is what the income is that we get every month. So there is a way that we can value that, calculate the present value of those annuity streams to include on our personal financial statements. And that can make the difference between whether an investor is non-accredited versus accredited. For people who are trying to be active investors and trying to sponsor deals in their own right, that they may have a higher net worth than what they think they do. So I don't want to go into any more detail on that, but I do have a short video on it. People who are in my investor club have already been sent that video, and feel free to reach out to me, whether it's directly or through Brett and JJ, and I'm happy to provide that for anyone who's interested.
Great information. I didn't know about that, so that's awesome. All right, so agency financing is going to start at $1 million. So you're going to be looking at deals that are, let's say, 1.5. Once we put a 70% loan on that, it's going to be right around $1 million. So I would start, if this is something that you're looking at as a general partner, start at 1.5. So these loans are 5-year, 7, 10, 12-year loans. You're not going to get that in the bank. These are a lot of flexibility. What we do is we start with the 10-year treasury. So if you were to Google 10-year treasury, you would find out that today's rate, earlier today, it was 4.32. Yesterday, it was 4.25. It fluctuates, and it fluctuates by the minute. So when you sit down, or when operator comes to me and says, well, what's the rate? I will look at the 10-year treasury, and this is how we make up interest rates. It's the 10-year treasury, or the 5 or the 7, depending on how long you want to be in this. And we use a spread. So for today, if we're looking, let's say, at a $10 million deal at $7 million, I'm going to put that in our small balance. I would say the spread is going to be about 250, 2.50. So 4.32 plus 250 is 682. So that's the rate. And we're going to get into—
What does that spread mean, Julie? What does that
the spread is how the lender, the capital markets, gets paid. So when there's a whole bunch of money on the sidelines and they're placing capital, they won't take as much payment. It's like a commission, if you will. But when money is tight, they're going to want to get paid a little bit more, because it's harder to get these deals done. You got to get support. You have to, these deals are a little bit more challenging right now, whether it's because of, money is tight, or we've got, some of the challenges in the market. So
and they're taking more risks, so they get paid for that.
Thank you. Yep. Leverage, depending on the market. If you're in Dallas, or you're Boston, San Diego, Los Angeles, Jacksonville, Miami, those are going to be 80% levered loans. That means the max dollars that I'm going to bring to you is 80. In a top, that's a top market. In a standard market, it's going to be around 75. I will tell you that even in Dallas, we're underwriting deals between 60 and 70%. So if you are looking at a deal and it says 80% when they've underwritten it, I would ask questions. Write that down. If somebody is saying, I'm getting an 80% levered loan, that you need to have a light bulb go on and go, tell me more about that, because that's not what's happening in today's market. It can down the road, but because the net operating income is not as high as the value that people are putting on these assets, we're not able to cover a debt service and give you the max leverage. So don't want to go too deep into that. But these loans will offer 1 to 12 years of interest only. So all of this money is coming in, and you're able to have cash flow out to your investors. It is amazing. 30-year amortization. So you're going to have lower monthly payments. Again, more cash flow. Costs you 1%. And then there's these prepayment penalties. Now, in residential, there are no prepayment penalties. Years ago, there was, but you can have a loan one day and sell it the next day. So let's talk about the prepayment penalty. There's a thing called yield maintenance and step down prepay. And I'm going to take the assumption that nobody knows what that is. So let's unpack it. So you're going to come to me, and you're going to, or the investor has come to the lender and said, hey, tell me how much your interest is I'm going to have to pay on this. Most lenders are going to try and give them the lowest rate. And that's going to be found on a yield maintenance penalty. And what that says is that I'm going to own this. Let's say I'm selling them a 5-year loan. And the operator says, I'm holding this for 5 years. We're going to sell them the 5-year loan with the idea that they're going to go to maturity. That means there's no prepayment penalty if they hold this asset until 90 days before close. There's no prepayment penalty after the 90 days. No prepayment penalty It stops at 90 days before close. Okay. Here's kind of, let me unpack this a little more. So you come to me, you say, here's today's rate is 682. And you're going to hold this for 5 years. If you decide in year 3 that I want to get out, our business plan is covered. I go to the capital markets and say, hey, Brett wants to get out of this deal. How much is it for him? What's the prepayment penalty? Well, if the interest rates go up from my 682 that I sold it to 8%, the capital markets is like, yay, I can take my capital that I just sold to you for 682 and I'm going to go sell it to the next group for 8%. So the prepayment penalty is minimized because they don't have to, there's no making them whole. They can move out of that. There will be a penalty, but it's low. Versus this idea of a step down prepayment. So if we take a 5-year loan, 1, 2, 3, 4, 5, on the first year, it's 5% exit fee. That's your prepayment penalty. Second year is 4, third year is 3, 2, and 1. So in that same example, you're coming to me and saying, Julie, I want to get out in year 3. I told you I'm not sure with yield maintenance, but in the step down, it's 3%. Remember, 5, 4, 3, 2, 1. So you're going to pay in rate up front per month, right? The interest rate is going to be determined depending on the type of prepayment penalty. So this is another question you need to ask the operator. Do we have yield maintenance or do we have step down? If it's yield maintenance, you don't know how much it's going to cost to get out of that loan. If it is step down, it's very clear. It's like throwing a feather into the wind with yield maintenance. You just don't know. But if you're going to stay in that loan for the duration, it's the way to go. Okay.
So it sounds like coming into a new business plan, a new acquisition is kind of a choice between having a lower interest rate and taking some uncertainty on the prepayment penalty versus a little higher interest rate for more certainty and lower on the prepayment penalty. Does that sound accurate?
That is correct. So if we look at, again, I told you the yield maintenance penalty is 682. If you get into a step down prepayment, it's going to add another 80 basis points. So instead of 682, you're going to need to price this at 762. So it's going to add so you can sleep at night. But that's something that your operating or your operators will want to look at. And you'll want to ask those questions. How much is it going to cost me to get out of this? Really important.
That's a lesson I learned the hard way. One of my earlier acquisitions, we used yield maintenance, and we bought that about a year before COVID hit. And then COVID hit, the interest rates dropped through the floorboard. And so when the interest rates go down, the amount of the prepayment penalty, if we had sold then, went way up, and all of a sudden it would have cost us like $2.5 million in prepayment penalty to get out of that, which is a heck of a lot more than 5% or 4% and 3%. So yeah,
absolutely. And that did happen to me as well. It was $2 million to get out and we decided not to sell. So this needs to be determined before we get into the deal, and your operator as well. All right. So the other things that are happening today in this market are assumptions. There's a lot of people that got in with COVID that used agency financing and they've got low rates and they want to get out. It's time for them to move on. So if the operator that you're working with, here are our operators here today, if they find an assumable loan, it might be a great option. Of course, it doesn't help us from a lending standpoint, but it really could help you as an investor, right? And an operator as well. Some of the things to be thinking about and asking the questions. You want to be careful because a deal that only has 3 or 4 and potentially 5 years left, there's not enough runway. Yes, it has a low interest rate of 3.75, but when you in your business plan is 7, because a lot of these deals are taking longer to return your capital, you're going to need to go get another loan. And we don't know what that looks like in 4 or 5 years, let alone 3. So it's difficult to underwrite them. You really need to cost them out together. And looking for something that has a little bit longer maturity would be the way to go on that. You want to make sure that we haven't gone into cap rates, and we won't spend any time today on cap rates, but you don't want to be over leveraging, and we call it negative leveraging these deals. That way you'd be losing day one. Okay, so assumptions could be great. You just have to know a little bit more to dig in. Let's talk about fixed bridge. But before we go into that, we talked about stabilized assets. Okay, a 90% occupied for 90 days asset could be considered. It's stabilized, but it also can be unstabilized, where you need to raise the rents. So we would look at a fixed bridge product, but you'd also look at a bridge product, or whether it's adjustable or fixed, when you have a CapEx budget. That means a renovation. In order to raise these rents $100, I need to put in $5,000 a door. That's when you would use the product, or you would use bank. And we'll go through that real quickly. This is a non-recourse product. It starts a little bit more expensive. I told you agency is around $657, right? A fixed bridge is around 10, $875 to $11, but I always say let's talk about 10%. So if you're looking at any deals today that have bridge and it's fixed, take a look at that. It's very important. These are 2 to 3 year loans where they're interest only. Never is going to change that payment, but it's interest only. I love it. And you would have the opportunity to potentially extend it. So in year 2, right before it matures, you could go back and say, hey, I need another year. It would cost you 1%. You would do more of your business plan. You say, wait, I need another year. So that 2-year could become a 4-year loan, or a 3-year could become a 5-year loan. So that's a great option. I love it. And you're going to get much better leverage. So if we talk about that $10 million loan we talked about on the last slide, I'm giving you $7 million on agency. On fixed bridge, potentially 75%. So I'm giving you $7.5 million in a loan. So that's one thing. Then I'm going to give you more money for your CapEx. Let's say you want to put $1 million into this. I'm going to give you potentially 100% of that. So not only have I given you 7.5, I'm going to give you another $1 million. That's 8.5. So 8.5 of a $10 million deal, or 11, it's really close to 80, 85% on some of these deals. So if you're a capital raiser, which product do you want to use? One where you have to bring in 3 million, or 1.5 to 2? And this is why fixed bridge is so cool, but it has to make sense. It's much more expensive. You have to have a good team to do those renovations, get people in and out, so that you can move on to your business plan to hopefully go to an agency. Now, maybe your business plan is, I'm just going to sell it. That's a great business plan. A lot of people use fixed bridge for that, but also to go into a perm loan, and that's when we would do agency. So these close very fast, 30 days. I like to do them a little longer, but we can get them done. There is this thing called the adjustable bridge, and if you've been around the block for a couple minutes, you'll know about an adjustable rate bridge. This is where we got into it. Interest rates went through the roof. We're dealing with that on a lot of deals right now. And listen, you can take out an adjustable rate bridge today. I don't think anybody would say that's a wrong decision. It just depends on your business plan. Okay. If it's a large deal, 20 million or more, and you've got a fairly large CapEx budget, this may be your way to go. Here's the thing. I recommend, if you're going to use this, you're going to want to buy a rate cap, and many people, a lot of lenders will require it. They did not require it earlier in the season, but now they do. And I also would capital raise a large amount of reserves just in case something comes up. So these right now are transacting around 9.5. And we're looking for, this is run on the Fed, the Fed funds. You're hearing Jerome Powell say, we're not going to move those. this is the index that we're talking about. SOFR, it's the short-term Fed funds. We're looking to get these down so these people can move out of these and sell them or refinance them. But there is a huge cost for these rate caps. This is like an insurance policy. So it is saying, hey, listen, if the rate goes up, I want to be covered. So in this example, this is a $20 million loan. It's going to cost me, if I look at, just this highlighted, this is saying that if the rates go from today is 550, if they go up to 750, I'm going to be covered. If it goes to 770, I don't have to pay that difference. It'll be refunded to me. I'll have to pay it, but then I get a refund from the insurance company, basically. But that policy for 3 years is going to cost me $1,189,000. Now, how many of you have that money sitting in the bank to buy one of these? I don't even like paying for my car insurance, let alone a rate cap. So these are really expensive. They're going to come down very soon. But if you're transacting in today's market, this is very valid, very expensive. So I say, stay away from the adjustable right now. Go to a fixed if you need it, or see maybe if you want to go to bank financing. There's nothing wrong with bank financing. Again, it's recourse. And you can start these at 200,000. Old Capital, we start at $1 million, but these are great loans. They're your local, your regional, your national banks and credit unions. So typically as a whole, because every bank is different, you're going to find 5-year loans on a 20 to 25-year amortization. So the every monthly payment is going to be a little higher than agency. Your rate is a little bit higher, 7 to 9%. You're going to get maybe potentially a little bit more loan dollars, but your monthly payment is going to be more. So you got it. We will look at this on every deal. What is your best strategy? Okay. You're still going to need net worth and liquidity, but depending on what the occupancy is, bank financing might be your only option. One of the things that we're seeing right now with bank financing is they're asking for a deposit. Now, remember, this is local banks. They want to have a relationship with you. And so, yes, you're going to give them your business account, right? The one that you're going to be operating on. But what they also want is about 10 to 15% of the loan amount to be put into their bank as a deposit, because the banks lend out money based on their deposits. So somebody put money into their bank, they're giving you a loan. Now they're asking you to put money in so they can continue to loan. Most people don't want to put and hold 10 to 15% in a local bank. I don't want to. I want to deploy it where I can know I can get maybe higher returns. But again, it might be the right fit. So don't say I don't want to do that. Look into it. I will tell you that in 48 hours, I can return to you or your operator how much a agency loan lender is going to provide. When we go to banks, they have committees. They want to know a little bit more about you. They want to see in your, your stuff. They want to see your tax returns. They want to see who you are. Not so much on agency. We're going to use your net worth and liquidity. So bank can be a little bit invasive, but it might be your best strategy. All of this to say, the most important thing you want to take from investing in multifamily, in real estate, is know the team that you're investing with. You never want to go in blindly. You could run some credit scores. You could get into, what am I trying to say? You could do a background check, okay? It doesn't really matter what the interest rate is if this group cannot deliver, okay? So do due diligence. Ask them questions. How many deals have they done in the past? What can I expect on reports? What are my returns going to look like? right? These are all important questions to be asking your operator, as well as if you're going to be doing this as a general partner, who are you getting in business with? What is their character like? I have a couple partners that have not done good by me, and I didn't necessarily think that was what I was going to get, what I was getting into. So be really, really careful. Okay. And now listen, when others are, this is Warren Buffett, and I'm sure many of you have seen this, but when others are fearful, you know, you want to be greedy. And when others are greedy, you want to be fearful because maybe that's not the right time to buy. People are fearful right now. So get out there and start investing, whether it's as a limited partner or an operator. Get your hands and get your feet wet into these deals. My question to you is, are you ready? Are you ready to take the next step? So I want to thank you, everybody, for giving me the opportunity to share about lending. I hope it was helpful. This is my contact information. You're welcome to come to my Zoom at 8. It's a great resource. Come to our old Capital Conference, and find me on LinkedIn and social media. Make sure you send me a note that, hey, I saw you on the Patriots webinar. So I'm
Julie,
going to
what's the
open
best
it
way
up.
for people to find your Zoom at 8 registration link, by the way?
Well, you would just go to dancinginvestments.com. Dancinginvestments.com. Remember, there is a password that comes with that, so you want to take note of that so you can enter in.
Okay.
Any questions tonight?
Tell you what, you mentioned about the cost of rate caps a few minutes ago, Julie. That almost $1.2 million rate cap you had up there. How much do you think that would have cost 3 or 4 years ago?
Well, 3 or 4 years ago, probably cost $74,000.
Exactly.
Maybe 100.
Exactly. And that's how some people with floating rate loans got in some degree of trouble because they had a prepayment penalty. I'm sorry, prepayment penalty. I'm using the wrong terminology here. They had a rate cap that came with a very low cost when they first bought the property, and then the costs went through the roof to be able to replace it. Or if it was a floating rate agency loan, which does exist, of course, then the agency makes you escrow in your mortgage payment for a replacement the whole time, and people's mortgage payments pay for the replacement rate cap escrow went through the roof unexpectedly. So definitely every tool has its purpose and has its place and the right scenario for it to be used. So you just have to understand what those right scenarios are, and connecting with someone like Julie is a great way to do that. She'll steer you in the right direction for sure.
Yeah, and listen, we do a lot of business with a lot of operators. We know their background, we know their deals, we know their locations. Happy to be a resource for you. But you've got really good operators in the room here. A lot to share with them, and they can really steer you well as well. Thank you.
Absolutely.
And Julie, just to piggyback on what you just said there, as far as the old Capital podcast and having the ability to reach out to your team, whether it be James Ing. I mean, we even had, coffee with Paul Peebles, who attends my church right here in Colleyville. He's just an amazing individual as well. So your group, Julie, has been incredible, and I just wanted to make sure that our team, and we're so thankful to have you as an expert in the lending side, come on tonight. So thank you so much, Julie.
Sure, absolutely. Happy to help.
Fantastic. Yeah, really appreciate it, Julie. Mm-hmm. Before we go real quick, we just want to mention this deal we've been advertising for a little bit for people who are in our who we already have existing relationships with. Midtown on First, we did close on this deal just a couple weeks ago in Tucson, Arizona, 94 units. We are still raising for the to finish up the capital expense budget. So if anyone took a look at this and already has an existing relationship with us and just didn't have the time to pay enough attention to it at the time, if you might be interested, feel free to reach back out. to one of us and have a conversation about it. So we've already closed, so that de-risks the investment. And since we're talking about lending, I'll mention real quick that we got this at a very low cost, 13.6 million. So it was roughly a 30% discount because it was under contract a year earlier for 19 million, and the buyer couldn't close. So it went back to market, and we got it at a really low price. We were able to actually get 74% loan to value on a Freddie loan with step down prepayment penalty on this. And just like you were talking about in your presentation, Julie, we paid extra in our interest rate to get that step down prepayment penalty, because everything is a balance. You got to do the balancing act on where the right mix is for the particular deal. So we did a 7-year loan on this, 7-year Freddie Mac loan with step down. So 5544321. We're really excited about this. We're right out of the starting gates. I was at the property 2 weeks ago, since I'm in Arizona all the time, and before long I'll be living there, and not in Tucson, but in Phoenix, but I'll be close by to Tucson, so I'll be there even a lot more often.
So
my fourth asset there.
Yeah,
So,
that's what I want to say, guys. What is really critical here is Greg has other assets in Tucson that's really, really valuable. And Tucson is an excellent market. So don't put Phoenix alongside Tucson. Tucson is doing really, really well. So just something to be thinking about.
Yeah, Phoenix is a little more volatile, has a little wilder swings than Tucson does. Tucson's kind of the more steady eddy of the market of the two of them.
Yeah.
And Greg and I had the opportunity to bring this to our 10X Bets team to actually have it scrubbed. Unfortunately, we were a little bit late bringing it to the team and having them review it and poke holes in it and literally review it to a point where he was very comfortable with this deal, and said, if you have another deal like this, bring it to the team on our syndicate team, and we will help you raise those funds. So just so you know, like, there's folks in our communities that understand how good this deal is, and that's why Greg and I wanted to bring it to our team here tonight.
Absolutely. Well, wrapping up, we appreciate everyone being here with us this evening. Our next session is going to be on Wednesday, July 31st, same time. While it's up on your screen, you can use this QR code to register. And just point of clarification, these QR codes down here, these are for our individual companies. If you want to connect with either of us and haven't done so before, you use this QR code to get to my contact information. Or this QR code to get to Brett and JJ's with BAB Investments. For the time being, we're still separate companies, although that could change at some point here in the near future. We'll leave that for another announcement.
And make sure you guys don't hesitate to use those QR codes right there and to reach out at any time. That's one of the most important things that as limited partners, we only invest with groups that are willing to jump on a call with us at any time. And we are the same way. So do not hesitate to get on that QR code, and our calendars are on there. You can schedule a time that works for you, and more than happy. Obviously, as you can see, we are super excited about multifamily investing, whether it be motel conversions, whether it be the value add properties that we're doing in Tucson, and just love talking about it and helping educate our tribe all around. So don't hesitate to reach out.
Absolutely. Well, Julie, once again, thanks for coming on and presenting to everyone tonight. We really appreciate your expertise and willingness to talk tonight. Brett, anything else you want to close out with?
No, sir. And just thanks everybody for joining. Y'all have a good rest of your evening. Julie, thank you so much again. Looking forward to keeping in contact with everybody on this call. And if you guys have any questions at all, feel free to reach out.
Absolutely. And I'm sure JJ says goodbye too. He had to duck out at the top of the hour because it's actually his anniversary, and he had a date with his wife that he had to go get to. So I can't blame him for that. So he knows his priorities.
First things first. First things first.
Exactly.
Y'all
All right,
have a good evening.
Thanks for coming.
Thank you.
Have a great night.
Thank you.
All right. Was that good? Was that I got it right at the end. That was good.
Yeah, that was great.
Perfect.
Yeah, perfect. Thank you so much.
Sorry, I thought you were going to interview me. So sorry.
No worries.
Okay.
I'm gonna text JJ before I get off of this and make sure that they have stopped their recording, because I think JJ was started recording. So.
I think once you hang up, it'll stop recording.
Okay. All right. Well, it was on their Zoom, not mine. So he's still on there. So I think he'll be on there for the next couple hours until he gets back.
That's gonna take forever to record. Shoot.
Yeah.
It may just stop when everybody jumps off. Let's hope.
Yeah, they have an assistant now who
Was that Tony?
Yeah, Tony. Yeah.
Okay.
I just met her tonight for the first time. So she just started working for them in the last couple of weeks. So
nice.
With JJ gone, I bet you she has the ability to go in and stop the recording.
There you go. Yeah.
Yeah.
Well, I'm sure gonna miss you.
I'm gonna miss you too, Julie. Well, we need to get together one of these days. I think
Yeah,
it's hard to miss each other when we only see each other through Zoom.
we were up in Temecula 2 weeks ago.
Okay.
Just ended up there. Wanted to go to get some oil, the olive oil, Temecula olive oil. So we spent an arm and a leg over there and just walked up and down the streets. It was warm, but it was very delightful.
Yeah, we were in. I guess that's right around when we were out there in Arizona house hunting. So we were out there for the whole week. The week of the 10th through the 14th.
You found something? You said you found something.
Yeah, we found a house. It's a new build. So it's out way out on the east side. It's technically in Apache Junction, but really closer to it's south of the 60, and it's really closer to like Southeast Mesa. It's only like 4 or 5 miles east of Phoenix Mesa Gateway Airport. So
well, that just be so much more delightful than what you're dealing with now.
Yeah, I mean, it's here. I never get into San Diego or anywhere. Just traffic getting through Temecula and the 15 is just horrible. Just terrible. We never go anywhere or go see anyone because I joke that I think I'll be better connected there because I know more people there than I do here now at this point.
Yeah.
Yeah,
that's crazy.
So we're looking forward to it. There's a lot of financial reasons it'll be good for us out there too, especially before some of the bigger deals go full cycle, for tax purposes. So yeah. So I'm looking forward to it.
Have you done all of that? Have you done that conversion? Like, is it that substantial?
I mean, I don't know for sure the California tax rate, but I'm guessing it would be in the 10% range.
Yeah, it is 9 or 10.
Yeah. And in Arizona, it's a flat 2.5% income tax. There's no tax brackets there anymore. So and they don't tax military retirement, whereas California taxes the air breathe.
That's terrible.
Between those two things and just lower cost of living and gas and everything else, it's better.
It's time.
It's time. I'm gonna miss this place. I just feel like they're running into the ground,
I know, it's terrible.
But it's becoming overgrown and like too much traffic, too many people, and I just don't want to deal with it anymore.
Yeah, I know. It's like everything's building up.
Yeah.
Like it's gonna pressure cooker.
Yeah. And my oldest stepdaughter, she and her husband live in Oceanside, right by our old place. And they're probably going to end up joining us like 6 months after we leave. So they live by our old place, and we were renting there before we we bought this house from 2018 to 2021. When we got there, we were paying $3,300 a month for like a 33,000 square foot.
That's huge. Yeah.
Older 1980s house. Needed some renovation, whatever, but we were renting, so whatever. A great spot, and now my stepdaughter and her husband are just down the street from there, like less than a mile, in an apartment complex. Actually, you is right across the street from where you used to teach. I don't know if you still do. Teach spin classes at EOS right there.
Oh yeah, that's a nice area.
Right there at Cannon and Melrose.
Yeah.
So literally across the street from EOS is that apartment complex. That's where they live now.
I know
and
exactly.
So yeah, so they upgraded last year from from another complex like 3/4 mile down the road that was in Vista, paying, I forget what they're paying, but they're in a 1-bedroom. They wanted to upgrade to a 2-bedroom, and so they moved in here, and they were, it was 24 or 500 a month, and then but then utility rubs and everything else.
I know, like what we're doing to all of our tenants.
So it was like 2,800, 2,850 a month or so for them last year, and they got their renewal notice, and now it's over 3,000 a month, and they can't do it. They just can't get ahead. It's like, how are we going to survive? And they can expect another increase next year because that's just how it works. And so they've realized they can't get ahead here in California. A lot of people can't get ahead here in California.
They can't.
But and you're right. A lot of tenants, that's what they're seeing in other markets too. It might be in Tucson. It might be in Phoenix. That kind of unaffordability is causing a real issue. And I wonder how much rent growth we can actually expect over the next few years because of that.
You saw New York City. They are now implementing 2.75 increases a year. 2.75 max.
Oh, wow. No, I hadn't seen that.
And Pasadena does the same thing.
Yeah.
So, I mean, for those landlords, they're getting screwed.
Yeah.
That's why I can't see it. And I'm concerned that some of these, if Biden or the Democratic Party stays in, there's going to be more of that. I think.
I agree. Even in Arizona, with the state flip-flopping between red and blue, and Tucson is more blue than Phoenix is.
It is,
Their city council, they have some stuff in there that's a little bit onerous. Their courts now, I guess we're supposed to be doing this anyway because of the what was that, the law, the CARES Act during COVID.
Okay. Yeah.
But their courts are enforcing it, that any property with a federally backed loan has to give minimum 30 days notice before filing for eviction.
Really?
Yeah.
Wow.
They won't even entertain it if you didn't meet that. So
have you gotten into the fraud situation at some of your properties?
Yeah, it's something that we've been looking at. I've been like dragging our property management companies into looking at it more carefully. There is I've been telling them, there are Facebook groups out there. There's YouTube channels where influencers get paid from YouTube and from sponsors to teach people how to defraud their landlords.
Sick.
There's I haven't had a chance to take a demo of it yet, but there is something called snapit.com.
Yes.
Have you heard about that?
We used it. We changed.
What'd you think? Okay.
We changed, and I'm going to have them on Zoom at 8, probably in either late July or August. They're going to come on. I've got a meeting with them Friday, I think. And we've been extremely happy with them. The first person that after we signed, it was fraud.
Oh my gosh. Was Snapit or different alternative?
No, I think it's DocuServe or something like that.
DocuServe? Okay.
Let me give you the right name.
Yeah, I've got several tabs open on my browser. I always have like 80 tabs open on my browser.
Oh my gosh.
Yeah, it's
okay,
crazy.
So this is where's this? DocuVerus. 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 DocuVerus.
DocuVeras.
US. DocuVerus.
Okay. You like that better than Snapit?
My partner does.
Okay. Has a higher claimed accuracy rate, 99.98%, where Snapit says it's where'd it go? I lost it. Says it's somewhere in here. I know it says 99.8. This is 99.98.
That's crazy. Well, I think something has to, you got to have something. So
do you know why? Yeah, I agree. Do you know why she preferred that to Snap It?
I don't know. I don't know if she got something through. I don't know, but she is managing, 48 to 5,200 units, and that's what she's using.
Yeah. Yeah. This new Tucson property, I'm using a property management company that I haven't used before. Because the last one the seller was using is the same one I started off with in Tucson. And at least at this property, they went way downhill. Not my first one, although I'm watching them carefully. So Vertical Street was the seller. Along with Break of Day, Gary Lipsky.
Yeah.
This is from when Gary and Kyle were still a team.
Oh, that's right. Okay. Yeah.
Yeah. So
that's the one that you just showed?
That's Midtown.
So,
Midtown. So we bought that from them, but I'm a co-sponsor with Vertical Street on another property in town called Metro Tucson that switched over to this new company like back in the beginning of January. So I'm getting familiar with them. But these guys, when we started talking to them, met with them shortly before closing on Midtown. I brought up like a tool like Snap It, whatever.
Yeah.
And they're like, oh no, we don't do anything like that. We just teach our site managers what to look for. And then they're like, yeah. And all this time, we've only caught like one case of fraud. And I'm like, really?
One is enough.
And they said it right as I saw the light going on in their heads right as they said it. They're like, we only caught one. Oh, does that mean you've only had one, or you only caught one?
Right, exactly. Oh, that was bad.
They're like, oh, maybe we should take a look at something like that.
Yeah, that's a problem. That's a problem.
Yeah.
So, have you been in contact with Brad? Have you been going to his current
actually,
events?
I haven't gone anything in a while. I ran into him at Best Ever Conference.
Oh, okay.
He came to Best Ever Conference for the first time actually, and he did a meetup there, and Brett and JJ and I went to it.
Oh, okay.
And so whatever. I talked to him a little bit one-on-one. I know he seemed like I made a joke at the time. I was like, I kind of like the new old Brad. He's been humbled,
That's exactly what Sandhya said. She said she's back in bed with him, if you will.
Really? Yeah.
Did you know that his Jen?
Mm-hmm. Yeah.
They broke up?
Yeah, I know.
I just found that out this morning.
Yeah, I knew I found out about that shortly before Best Ever. So when I saw him there, it's one of the I wasn't trying to have a private conversation with him. Yeah. But I accidentally walked out. After the meetup was done, I went in the bathroom, and Brett and JJ were outside waiting for me, and I walked out of the bathroom, and he was standing there. So I felt like I had to go say something. And we were talking, and I said, by the way, I just want to let you know I heard about about you and Jen, and I just want to express my sympathies and condolences. And he started whipping his phone out, like trying to show me text messages saying that, oh yeah, we're still friends, we still talk all the time and everything. I'm like, look, it's not my business, it's no one else's business. I said it's just I said I've been divorced a couple times, and no matter what the circumstances are, it always sucks. It's always painful for both parties. And I just wanted to express, just man to man, just say, hey, my sympathies for what you're going through. Feel for you. And
well, she was on all those deals, right? I mean,
I have no idea. I don't know how they were doing their stuff, and I don't know.
Oh my gosh!
I don't know what the deal was. I haven't heard anything. I haven't asked. Like I said, it's none of my business. I don't really care too much.
I mean, Paul would have them over to their house. They'd go on vacations together. It was like.
Have you heard anything about the reasons why or anything like that?
No.
From the speculation I heard from people was that he was just getting too full of himself, and it wasn't the direction she was aligned with.
But everybody said it was Jen who was pushing him to be that way. That's
Really?
What I heard.
Yeah, I don't know, but what I saw at Best Ever Conference was he's trying to go back to closer to the way he used to be.
Yes, that's what I heard.
Yeah, he's not trying to be quite as profit focused as especially with his programs, as he used to be. He's trying to take his mastermind back to being about multifamily instead of trying to be Tony Robbins and stuff.
Yeah.
Yeah. I don't know. I wish him well. I also got a notice like 2 weeks ago that for my annual renewal, and I haven't filled it out or done anything with it, and I don't think I will. So
a lot of money.
I think well, it's like $3,000, and in the past it's always been like, it's been like, for me, we're grandfathered in at the time we joined, so 2015 it was $3,000. I'm like, if $3,000 gets me into a new deal this year, great,
Could be, yeah.
But
that's
now,
nothing.
At this point, I just feel like I've passed the point of diminishing returns with that. So,
and you're still doing Vertical Street?
I'm still, but that's been dying off too. The amount of energy and focus they've put into it has been dying off. And for the students, it's been so much hard to get deals the last couple of years. A lot of them have lost interest and gone to pursue other things, and so a lot of students have left. I think they're focused more on trying to save their portfolio at this point. So,
but they're with, what's his name, Maldonado, who drives around in the hot cars and
well, he's not part of them, but they partnered with him for that one deal.
Yeah.
That was that development deal. Yeah. Jerome's actually, I've met him, and he's okay. Who doesn't like to drive around in nice cars and everything like that? He's actually a pretty down to earth guy. Yeah,
I thought he was a little bit much, personally, but
I know the type. I actually he's tries to talk big on stage and everything like that. But actually, I've heard like people I know who, like, some Vertical Street folks joined his program, and I've heard that he's actually like a super nice guy and really super down to earth. So
that's good.
Yeah.
So do you think that Vertical Street will go away?
No idea. I haven't heard anything that would lead me to believe that. But
you're still coaching them with them, right?
I'm still coaching with them. So is Rebecca Moore. Yeah.
Oh, I like her so much.
Yeah, she's fantastic. So I mean, I haven't heard anything to the contrary, and they still have students, so I'm still just doing my thing. I haven't been able to put as much time into it lately, so if it went away, I'm like, oh well, so no big deal. So
wow. Well, there's so many people that have been there, like Alex and Karen. Cruz, I think is what you say. They have been so devoted, and it's just not happening. They're just not getting deals.
Yeah, it's tough.
Yeah,
it's tough. There's a group that, well, they're a part of the group, a larger group that has been trying to get some deals with this guy Josh DeBlay. I don't know if you've met Josh before.
I think I have. They just had the baby.
Yeah, their second one.
Yep.
Josh and Patricia. So it looks like Patricia, but she's Colombian, so it's Patricia. Something like that. Yeah. So they just moved from Boston to Northwest Arkansas last winter. Like 6 months ago. So they're working with Alex and Karen and Jose Miller from Phoenix.
Oh yeah, I know Jose.
To try to do a deal, and a guy named Casey, who's in Ohio, to try to do something there in Northwest Arkansas. So I like
Northwest Arkansas. It's great.
They submitted
great
several LOIs. They just haven't gotten anything yet. From what I see, it looks like they're being a little bit timid, and they're trying to underbid. And it just hasn't worked for them yet. And Josh sees that. I've tried talking to him about that, and but it's just the group as a whole that's been, kind of okay.
Wow. Best of luck. Yeah, right. So when are you moving? When's the house going to be finished?
The house won't be done until November, December timeframe. Maybe even January on the outside. So we're getting ready. We haven't listed our house here yet, but we're getting ready to.
Okay.
So I expect, depending on how long it takes to get under contract, I'm expecting September, October timeframe will be have to leave this house, and also depends on.
So you think it'll close that fast?
Yeah, I don't think it will be able to do door to door. I mean, we might try to lease back for a couple 2 or 3 weeks, but. We want to try to minimize any kind of temporary living situation, but I think it's kind of inevitable that we're going to have one, because we're not gonna, we can't get approved for non-contingent.
Yep.
We have to sell this house first before
Yes.
we close on that. So
that's what we would have to do too.
yeah.
Well,
So
thank you so much. Again, it's
Yeah.
just such a great pleasure to
yeah,
help.
thanks for coming
So,
on. Thanks for coming
yeah.
on. I really appreciate it.
You're welcome.
Let's definitely plan. Well, we're around for the summer. I actually the next our travel schedule is pretty light the next couple weeks, except for couple months, except for getting ready to have our open house here in a few weeks, and I'm going up to visit Brett and JJ in Wyoming.
Okay.
So for a few days in a couple of weeks. So we can do some planning. Like I can see a little bit of work and pleasure. We'll do some hiking and
I'd love
seeing
it.
Wyoming for the first time. But at the same time, we're all going to put a couple hard days in of
That's
working on
great.
putting together planning for this new company we're going to be building. So no,
They seem very nice guys.
yeah, they are. They are.
I really
And
like
feel
Brett.
very aligned.
I didn't know Brett well. He's really nice.
He's super nice. He's a really good speaker. He
Yeah,
talks
he
really
is.
well. He's a very good communicator.
Yeah.
He's not on the real estate side of things whatsoever.
Oh.
That's all JJ.
Okay.
He wants to focus on capital raising and having those conversations with investors and all that kind of stuff. So, but
Okay.
he doesn't get into asset management or underwriting or anything like that.
Wow.
He
Okay.
knows about it, but that's not what he wants to do. So,
Okay.
yeah.
Well, if you, I've got Saturday the 13th or the 14th, if that's something. Oh no, not the. Oh yeah, Saturday.
That's what I'm going to be in. That's what I'm
Oh,
going to
you
be
are?
in
Okay.
in Wyoming. Although I do come back the morning of the 14th. I should be home by like 10 or so in the morning. But yeah, let's take a look. The following Saturday, the 20th, is when we're going to be doing our open house.
Oh, okay. Yeah. And then I've got the 27th open.
Yeah, we do too. I think we haven't even looked
Okay.
that far out yet.
All right. Well, I'd love it. We could even go for a hike. I don't know if Tina would be interested in hiking, but we're big hikers. So
yeah, I'm a huge hiker. She would be
Yeah.
interested if it's an easier hike. She's not as big a
Okay.
hiker as I am.
Well, we
So
can't leave her at home. That would be
I
rude.
know. I know.
So I'm gonna put it on.
Okay.
And hopefully we'll figure out,
Yeah.
sometime in that week if that still works.
Yeah, that'd be great.
All right, perfect.
All right, Julie. Have a good
All
one.
right, talk to you soon.
Okay, bye.
Okay, bye-bye.